Okay guys, and welcome to lesson 5. We're really starting to get into the nitty gritty side of things now, so we're going to start nailing in our entry model and how we're going to take the trades and stuff like this. So we're going to be, I've got my notes in front of me, so we're just going to go over the entry model. Obviously do that step by step. That is going to include the secondary entry model. So obviously we have our entry model that I showed you, where we look for the liquidity sweep, then the shift of structure, and then entry off the Fibonacci, and then our added part of the model is just going to be the continuation entry, which is basically the same thing but without the liquidity sweep. The liquidity sweep doesn't always happen, so that's going to be that. And then yeah, we're just going to pair it with the time frames, ranges. Obviously ranges and time frames kind of blend into as one, and yeah, and then obviously just our entries all together. So yeah, let's jump straight into it. I'm on the NZD USD, and I've actually seen a continuation trade. But what we want to do, remember, like I said before, this will work. This strategy will work on all time frames. But I am teaching you the style and the strategy I exactly used, including with the time frames, to what got me away from my 9 to 5. So if you are like what I was in, like the same position that I was in, i.e. a builder on building sites, especially London. You miss London and you miss New York trading sessions. That's it, because you're on site for 8 o'clock when London opens, so you have to be on site for 8 o'clock, and you're not leaving site until New York sessions, the main liquidity session, volume session, whatever you want to call it, has finished. So you have to be more swing trading. So like I'm saying, you can use it on the smaller time frames if you're available to do it. But we are only going to solely focus on the higher time frames and how I used to trade it. So the first model we've been looking at over the last few weeks is just a simple liquidity sweep model, then entry like that. So that's what we're looking for. We're looking for the liquidity sweep here. That can be either a candle closure above or just a wick, so it doesn't matter how this wick's above or candle closes, as long as we get a strong push to the downside and we close below the low that caused that liquidity sweep to happen. So, and then we can obviously draw our Fibonacci, and then our entry would be from that specific area that we plotted out. And we always target just the 2R. We don't go for any crazy risk to rewards. We're looking for 2Rs because it gets us in, gets us out. Sometimes we can be in trades for a long time, days even, a full week. So we just look for the 2R. And why this trade is in place, and the order's even been placed and you're waiting for the orders to get tagged in, we can look for other trades. With this strategy, it's not a situation where you can only wait for this one specific trade. This is why we have such a big watch list. We have major pairs and we have minor pairs. That is it. Obviously I say that is it, there's a huge list of pairs there, so literally every single major and minor pair is what we look at. I separate the major and minor pairs because the major pairs is what we solely want to focus on the most, but if there's nothing on those pairs, then we do drop down to the minor pairs and we can just really scour in, and we can end up having like 4 or 5 orders on the charts in 1 week. So you might complain and say, I want to go for more risk to reward, I want to get a bigger percentage return. But when you've got this amount of pairs, just think about how many trades you could possibly be winning within a week. So if you're getting 2R and you're making bloody 5 trades and you're winning all 5 of those trades, you get the point. So the percentages can rack up very quickly when you're swing trading. So yeah, that's entry model 1 anyway. Waffled on a bit there, but that's entry model 1. And then the next entry model is basically just say we're continuing from here. So we break to the downside, and we're just looking for that. We're literally looking for that. So we would get in off of from this high to this low, entry, and then we can continue that to the downside as long as we understand this is our breaker structure here, and we're looking for that continuation model to the downside. So this would be our first trade up here. Stops at the highs, of course, guys. Take profit at the lows. We hit take profit. We're following higher time frame as well, so we've got to keep that in mind. And then stops at the highs, take profits at the lows, and we can continue that model until the shift changes. So we can do that again, and then this might happen, and then you might start looking for buys. Yeah, so you can literally follow the pairs over and over and over again. Stops at the highs, take profits at the lows. Another two are there, and then you might take the trade here, another short, and you might take the L, which is fine. It doesn't matter because you've just won 3 in a row. But then what do you notice? You get the breaker structure. Obviously, you're looking for shorts. Then it continues to the upside and takes out this high, causes a market structure shift. So then the market structure shift happens, wherever the market structure shift is on my thing, market structure shift. Then instead of this being a breaker structure, you can change your breaker structure, because obviously you would have had this marked as a breaker structure. Once the market structure shift happens, you can go here, swap this out for liquidity, and then your bias is changed for buy positions. And that's what we look for. So you can literally just stick to one pair and just follow the momentum. Once it flips, follow the new momentum, and you can really just see how we can continue that pressure on these pairs that we trade. And then literally a continuation plan is right here, and this is actually a really good example. It's a shame that the gap's there from the weekly open, but you can see the movement here, right? So we're in this trend. We get this liquidity sweep, we get this market structure shift, push the downside, then we pull back up. Let's get our high to low position in place. We tag in, keeping in mind as well our confluences, supply and demand zones and fair value gaps. What does this Fibonacci line up with perfectly? The fair value gap. This is what we want to see. So this is when we start adding our confluences and putting all of our things together, all of our pieces of the puzzle together. We look for supply and demand zones and fair value gaps. When we plot the Fibonacci in onto the chart, if a fair value gap or supply and demand zone lines up with that, our entry line on the Fibonacci, that is a lot stronger of a level. Fair value gaps, we expect price to come in, test them, fill them, whichever one. We expect price to come back to those areas. And if it lines up perfectly with our Fibonacci level, our entry level, that is just an added confluence. So here we get our traditional model that we're looking for, the liquidity sweep, the market structure shift, the return to the Fibonacci, and a very clean 2R happens. And then what happens, once we break structure here, obviously you would draw the Fibonacci. We pull above the 50%. We respect this fair value gap here, and then we push down. Fine, we don't get an entry, that is fine. Remember, this is on the 1 hour time frame as well. Then we break structure again. So we can see here, we broke structure here. And then, once again, we've got a new high to new low. So we've got a high here to a low here. I used the range tool, but I could have just used the Fibonacci. But you can see there, high to low with continuation. The continuation move is happening. Let's just delete that one. Then we get our Fibonacci again. Fibonacci, high to low. What lines up with the Fibonacci entry zone? Another fair value gap. We can get our entry off of here. Bosh, bosh, and bosh. We get a nice 2R. Another confluence as well we have spoke about is liquidity. This area here is liquidity. So this little high here, this little internal high, that's the liquidity area. So we actually get a sweep of liquidity, tap us into our fair value gap, taps into the fair value gap, tags us into our trade, sweeps out liquidity, and then reverses to the downside and hits our take profit. So another area that needed to be swept out before price moved to the lower, to the downside. So there's an entry model there. So we've got literally get both of our entry models in one, not one session, but in one leg. So we get the reversal, i.e. with the liquidity sweep model, the very strong model, that's a very strong model, and then the continuation model straight off the back of that. So 2 entry models in one pair, in literally one leg as well, which is really nice to see. And with this liquidity sweep here, on the lower time frames, this could potentially be another one of these. So let's have a look. 15 minute. So we get a liquidity sweep, we get a push down, we break structure, yes, we break structure, and then we return. So yes, it does happen again, see? So we get a liquidity sweep, break structure here, just about break structure, but we do break structure, and then you can draw your Fibonacci from here, from this high to this low. Entry off of the Fibonacci zone, which also lines up with another fair value gap, and then you could have got another entry off of that. So you could have had 2 entries in one trade, basically. You would have got entered there, stops would have been at this high, and then you could, instead of just targeting that low there to get another 2 high, you could have just continuation with the higher time frame trade and then got a 4R basically. So yeah, there you go. But yeah, like I said, we're concentrating on a higher time frame. I just wanted to show you that this happens all the time on every time frame, and you can even pinpoint them on the higher time frame and drop down to the lower time frame and get an additional entry. And then what would we be looking for here? Obviously another continuation. So let's just delete all this, and then at the minute we would literally be looking for something like this down here. We would have been entered possibly, so now we're waiting to see what happens. We're getting a big rejection. It lines up with a fair value gap. There's also a fair value gap up here. I'm not sure if I explained this, but in a leg, let's use a thingy tool. In our singular push down leg, we have multiple fair value gaps. The most important fair value gap and the most strongest fair value gap is the one closest to the top, especially in this example. Oh, sorry about that. Yeah, so in this example, when we're in a down move, our most strongest and valid fair value gap will be the top one, unless obviously we go to the higher time frame and there's another one there. So there is a 4-hour one here, so this one is our strongest one. But whenever you're looking to, say you are looking on the 1 hour, this one here would be your strongest fair value gap. So that's the one you want to focus on the most, not these ones. Especially when we're looking for inversion fair value gaps, that's the one we want to see get inverted to help us confirm that we could be potentially going to the upside. So yeah, try not ignore these. These are resistant levels, but they ain't going to be as strong as this one. But like I said in the previous videos, the higher the time frame, the fair value gap, the stronger it is. So this would be the one we would actually concentrate on, and we are actually rejecting that. We've filled it and we are rejecting it, and the Fibonacci entry lines up perfectly to push us down potentially. Is there one on the higher time frame? No. So there's no. So our highest time frame fair value gap is the 4-hour one on that leg. We do have one higher up here in this area, but that is to do with the weekly. Yeah, that's to do with the weekly open. So that's going to be a bit of a fishy gap to worry about, because we have wicked up and we have filled it as well. So yeah, so that one we don't really want to be worrying about that. But we are very bearish. Overall time frame is very bearish, so we only want to be looking for shorts, and following that time frame alignment is perfect. So we would be looking literally for that. That's the trade we'd be in now. We would be in minor profit, lining up with that fair value gap. Also there's a supply zone up here. This one will probably be better to use. That supply zone there, we've tapped in, we're respecting the fair value gap, we've tapped into the supply zone. That's 2 confluences been hit, and we have entered off the fair value gap. So yeah, overall we are bearish as well. So the idea now is just to continue to the downside. That is the idea on the NZD USD. Putting the higher time frame narrative in line with it. This, when it comes to this swing trading strategy, it's not crazily important, but when looking for trades, it does really help. So in this whole scenario, which is quite a crazy scenario, we are actually looking at this range here. So from here to here, this is our leg. We are coming below the 50% now, so we do need to be very vigilant. And what I mean by being vigilant is we just need to be careful now, because on the weekly time frame we've come below this 50%, and what do we do when we come below the 50%? We are looking for buys. So higher time frame wise, we are actually looking for buys, but we're not going to be looking for buys until the lower time frame, i.e. the 4-hour, 1 hour, aligns with the higher time frame. So we just need to make sure we keep that in mind, because even though we're in this short now, we could potentially start breaking these structures to continue to the upside now based on the higher time frame. So we just need to be vigilant about that. So even though you might have entered this trade, it's just about understanding the risk, because we have come below the 50% of the weekly now. Any moment now we could potentially reverse, so we've got to be careful. So taking this trade is fantastic. It's a great trade to take. It lines up, all of our confluences are perfect. The fair value gap, the supply zone, the overall trend at the minute is down, bearish. The Fibonacci lined up perfectly with the fair value gap. We entered, great. But the higher time frame, we have come below the 50% now, so we could potentially be moving to the upside at any moment. Potentially though, so keep that word in mind. So that's just about understanding your risk there. Are you willing to risk basically taking that short, knowing that we're this low on the higher time frame where we could literally reverse now and continue to the upside and taking out these highs here and then potentially come out to these highs? It's just about weighing up your options. That's all it is with a higher time frame. Don't get too invested in it, but you need to know where you are. That's all I tell my students, is don't get too invested in a higher time frame, because we are looking lower time frames. Obviously with this swing strategy, it's not very little time frames, but you still just need to keep it in mind, but don't get too invested, because that's how you can get very muddled up with the markets. Right, let's see what else we can find. It's going to be interesting to see how this plays out. We might see in the next video where we're at with this, but yeah, we'll see. But we're in it, obviously not real life in it, but we are in it. And we'll see if that actually plays out. We would be in profit now. Let's go back. Let's see if we can actually find anything. Yeah, I've got loads marked out here. We've got continuation models here. Some of these continuation models do actually they all take out liquidity, which is really good as well. But even if you don't notice the liquidity sweeps on these, you still would have took them as continuation trades anyway. So here you was in our liquidity sweep happens, but where's the breaker structure? It is a bit very messy. So you probably wouldn't get in a trade here. There's not really any clean entry model. The breaker structure doesn't happen till here, where a weekly gap opens. So it's a bit confusing. So you would have not got in here, because obviously you got the liquidity sweep here. You get the push down, but the break doesn't happen till here, which is the new weekly open, and it pushes up. Very confusing. So you would have waited. But you do get a minor liquidity sweep here. So we get a little liquidity sweep here. Push down, break structure, return to the Fibonacci area. That aligns with fair value gap. You're seeing the pattern here now. It aligns with the fair value gap. It tags us in and it pushes to the downside, hitting our take profit. Then we continue. Obviously now we need to wait for these lows to break. So all of this stuff here is just noise, it's just mess. When do we create this low here? Is once we break here. So we break this low with this candle. What was the high that created that low? It was this one. So this leg here from point A to point B. So this is our continuation model. And like I said, you might not notice some liquidity, but liquidity gets taken here. So we get liquidity taken here, but it's still just a continuation model. So if you don't notice the liquidity all the time, but you know you're looking for a continuation model, you don't need to mark it at. But it's good to mark out. So we take out two areas of liquidity here. So we take out these two highs, we push down, we break this structure for a continuation, and we break the overall structure as well to help with our continuation. Then we pull back up. No fair value gap in on this one. Let's go to the 4 hour, see if there's anything, if there is actually anything. No, so there's no confluences, i.e. Where's that gone? Fair value gaps or supply and demand. But that is okay. So we get the entry because we're looking for an entry continuation model. So we get the entry very clean. It springs up, tags us in, and then quickly rotates to the downside. Let's see if we can highlight the higher time frame. If there's a clean explanation for the higher time frame on this one. Nothing clean on this one. So this is the area we're looking at. We are bullish, but there's no clean leg to the downside, so meaning that we've got no clean range. We've come up to here, we've started to pull back, but we haven't come below the 50%. So we're not looking for nothing. So we're still looking for shorts basically. But what do we notice? So we've taken out all of this liquidity over here now. And then what we do notice is once we create this new leg, this is our high that creates this low here. You got to keep in mind with the structure. So this is our high, this is our low. We push up, break structure, liquidity sweep. So that's a reversal play. So we get a nice reversal play. Remember what I said earlier is that we just keep continuing. So we keep following that trend. We keep taking continuation trades until the market shifts. So this is what we've done here. If this wasn't on a Friday and this weekly gap wouldn't have happened, this would have been a very clean entry model. So you would have got 1, 2, 3 entries to the downside. And then you would have noticed this. Liquidity sweep, impulsive move to the upside, return to the Fibonacci, and we move away. Obviously you only go for the 2R and you get the 2R. So you made literally 1, 2, 3, 4 trades, but realistically we made 3. So 3 trades in that 1 week. And that's just off that one pair. Then we come to here, we push up, yes we do break, so we get a liquidity sweep here. Obviously you'd be looking for a continuation trade, so potentially you could have lost, but if you're looking at higher time frame wise, you get the point that we're in this very extensive push to the upside. We could potentially be looking for a reversal at some point. Let's look at the higher time frame again. Yeah, so we break structure here, so we've broken structure here on the higher time frame. This would be daily and 4 hour, by the way. Yeah, see, so daily and 4 hour. So our new range is literally this. So we're looking for here to here. And obviously we're not looking for buys until we come below this 50%. So once we start getting that pullback, yeah, this is it. So we've got a new range joint now after daily. We get that breaker structure. So yeah, we only really want to be looking for short positions because we've broke structure on the higher time frame, and we know and we get that there could potentially be a pullback. Obviously there's going to be a pullback at some time, and what happens here, we get a sweep, extensive push to the downside, breaking structure, and do we return? This one we might not actually return to anything, and you would more than likely take it from here. Oh, and you do, yeah. So you do. You get actually a really clean entry on this one. A wick through entry, off of that to that, and then another 2R. Nice reversal trade there. So you get the liquidity sweep. Liquidity sweep. Breaker structure. Let's just mark that out. Breaker structure. Return to Fibonacci. And we enter and we reverse to the downside. And then what are we doing? We're looking for a continuation trade now because we want to get down to this 50%. We do actually come down and tap this 50%. You can obviously use a main high, which we don't get, and then you can try this higher, and we do get. So if you go off the normal logic, obviously, what is the high that broke structure to the low? And it is actually this one here, and it does actually sweep liquidity. So didn't even notice this until I just see it. So it minorly sweeps liquidity, which obviously makes it a very stronger entry model. So we get a sweep of liquidity on the continuation, an extensive push downside, which breaks this structure level on the Fibonacci. We just use the Fibonacci as the structure level. Break the structure level, we draw a Fibonacci, we return, we tap in, and what are we looking for? Another 2R, which we get. And then we push down, there's nothing clean there until we start consolidating. We don't break structure until we don't break structure. So you could have potentially have been in a trade here, but I potentially wouldn't recommend it because it's not a very exciting swing. It's not like this where you get a bit of a consolidation to the upside, nice slow movement, and then an extensive push down. You want to be careful with this style where it's a couple of candles, then a straight up pullback. You've got to be careful, and realizing that we're very low in the trend now. So you don't want to look for a continuation because you get the point that we're below the 50%. This trade got us to below the 50% as well. You don't really want to be taking sells here because we're very low in the range. And then we reverse, we push up, no liquidity sweep happens. Obviously you do get one here, very extensive push to the upside, but then we can pull back, we continue. Nothing, it's a bit messy for now. Then we pull down, we break structure again, then we break structure back to the upside. Yeah, messy. And yeah, that is that on that one. What was I looking at again? So we've done the entry models, we've done ranges. Keeping in mind, higher time frame is not overly important when we're swing trading. Just keep it in mind, because obviously, like this situation here, if you didn't have this higher time frame range drawn out, you would have still been looking for shorts, but not realizing you're below the 50%. So you just need to keep in mind the higher time frame. Have your range drawn with your GAN box or however you draw it. And then once you start getting below that 50%, stop looking for sells. You do not want to be selling once you're below the region when you could potentially be reversing. And that's why I was saying about here, we need to be careful, because on the weekly, we are below the 50%. We could potentially reverse to the upside. So this is a higher risk trade compared to the ones up here. That's all you need to do. You just need to be careful with the range. That's why we're using the range tool. You want to use the range tool on the weekly, in the daily, and the 4 hour sometimes, depending on if you're finding trades based off the 1 hour. Sometimes the 4 hour range is really good. That fits well with the 1 hour. So weekly, daily, the 4 hour. Your entries are off the 4 hour, 1 hour. I personally like the 1 hour the most. But yeah, you do get a lot of entries off the 4 hour as well. And then this is one I'm going to go over. This is going to be the last one I go over, because this literally pairs everything together. So this is the one we went over the last video, and I said we're going to probably go over this a lot. So we're going to go over it again. This one here, daily range, we're pushing down. You can see the continuation model is just playing out and playing out. And once again as well, guys, remember you can use this model on the higher time frame. So if you really want to swing, you could have took a trade here. You could have took a trade here. Obviously that might have swept you out, but you get the point. Then you could have took a trade here and then got an entry on the lower time frame. This is our key area for our entry. This is actually just a perfect trade setup. We're following trend. We broke structure. We've come back above the 50% of the range. We've respected a fair value gap and supply zone. This is off the daily. You could have entered off the daily Fibonacci if you really wanted. So you could have got an entry off of the daily Fibonacci there. Beautiful. So that would have been a big swing. So we would just put it over here. Just make that, shrink that down. So you could have got a daily swing there. Let's get rid of the drawing tool. Daily swing there, and then you could have come down to your 4 hour / 1 hour. And then while that's playing out, once you've got the entry off of that, very confident, you're in the zone, trading in the zone. Obviously you get the point, we're in the higher time frame range, we're bearish. You can just see very clearly on the daily, we are very, very bearish. So higher time frame wise, we are looking for shorts. This is when it comes to pairing a time frame, right? Higher time frame, we are looking for shorts. We've got an idea for a daily swing. We can leave that order on the table and just let it play out. But for a lower time frame confirmation, we want to see the lower time frame realign with the higher time frame. So we want to see the lower time frame aligning with our higher time frame, which you see here. So higher time frame, we are daily bearish. We have a daily swing order set here. And then to get a lower time frame entry, i.e. the 1 hour, 4 hour, in this case the 1 hour is the best. All we need to do is wait for this bullish structure on the 1 hour to convert and align itself with the higher time frame, which is bearish. As soon as we get that flip in the market, and what is our entry model? Our entry model is we're in a downtrend. We're looking for a short. We look for a liquidity sweep, market structure shift, return to Fibonacci, and a drop to the downside to continue our model. It's as simple as that. So what are we doing? What do we see right here? We're in this 1 hour / 4 hour uptrend. We actually tap into the daily order that we had set to set our higher time frame swing model. And then as soon as we hit that, funny enough, we get that push up, tag us into our daily order, liquidity sweep, huge displacement to the downside, causing a market structure shift. We're leaving fair value gaps and a supply zone. The fair value, let me mark that fair value gap out. So we leave a huge fair value gap and a supply zone. We pull back up. Our Fibonacci, once we've drawn that, aligns perfectly with actually both confluences, the supply zone and the fair value gap. We set our order, stops at the highs, take profits at the lows. If you're really confident, you can obviously put your take profit with your daily target as well, just to continue that move. Entry, and then you sit and wait, and it plays out perfectly. You get two trades off of that one trade plan. So that's where we pair everything together. So like I have in my notes here, the entry models, our continuation entry model, we've got our reversal entry model, which also can be used as a continuation entry model if you notice the liquidity sweep. Our ranges, i.e. our higher time frames, linking them with our lower time frames, and this is the perfect scenario. Our daily range is bearish, our weekly range is bearish. We can set a swing order for the daily to play at, and then once the internal range shifts and aligns with our daily, we can enter on the lower time frame to look for that continuation to the downside, and then you would have made just under 6R on that, and then obviously your general 2R on the swing trade. So you could have made around about 8% in this one move here. And that is literally it, guys. So lesson 5 is coming to an end, but that is the model. And when it comes to pairing all the time frames, if you've got this locked in, you can make a lot of money. Especially once you start aligning the higher time frame with your lower time frame entry models. But like I say, always just go for the 2R anyway, because you never know what's going to happen. Obviously you can be married to that higher time frame, but this trade here might hit take profit, and then the market might flip, and then your daily swing trade might not hit take profit. So you've got to be very careful. So that's why I always stress, just go for your 2Rs. You can stretch that down, but I recommend just going for the 2Rs. But yeah, that's the entry model you're looking for. Sweep of liquidity, huge strong displacement, i.e. just a strong candle to the downside, breaking structure, causing this uptrend, this bullish trend to now shift to a bearish trend. That displacement left fair value gaps in a supply zone. The Fibonacci entry zone lines up perfectly with both of those confluences. Price pulls back, it enters, stops at the highs, take profits at the lows, and we get our 2%. Perfect. Yeah, I'm actually going to wrap it up here, and we will move on to lesson, I suppose it's just going to be the last lesson, because with this swing trading strategy, there's not much to go over. I've literally gone over everything now. What we look for, as long as we understand market structure, which if you watch the previous videos, you would understand market structure. You understand liquidity, you understand our confluences, our fair value gaps, our supply and demand zones, our liquidity. And then you know how to plot the Fibonacci tool on and understand ranges. We are really in a good position. So this is literally the strategy that I use, like I keep saying, to get out of my 9 to 5, and this is what got me away from my 9 to 5. And this strategy can be used on all time frames. I have said this multiple times. But if you are in the same position that I was in, do not stress and think because you're using a higher time frame, it's going to take you years to get out of your 9 to 5. I had done it in literally like a year. Literally a year, just over a year. When you've got such a big watch list for swing trading, you can make more money than what day traders make. Trust me on that one. The only reason why most people go from swing trading to day trading, like myself, is because now we are at the computer a lot more. We're literally sitting at the computer all day, or whatever we're doing. We like to be in and out of the market quick time. So that's one of the reasons why I do it now. I want to be in the market, out the market, be done for the day. I don't want trades running for days or hours or weeks or whatever. I don't need to be in that position anymore where I'm sitting on a trade for fucking hours. So that's the reason why I day trade now. But use this model to get you out of your 9 to 5 and get you fully funded and get you consistent profits and whatever else you need it for. And then if you want to convert to day trading, you can do that. But use this model. And this, like I said, this model works on any other time frame. So even when you quit your job and if you don't want to do swing trading anymore, you can still look for this same setup, just apply it to the lower time frame. So use the 1 hour for your ranges and then use a 15 minute, 5 minute, 1 minute for your entry model. Look for the liquidity sweep, the displacement to the downside, the return to the Fibonacci, enter. Done. Simple. Same thing. Just stick to swing trading if you're in a struggle job like I was, i.e. building sites where you've got to be on site literally all day long, where you're missing London Open, New York Open. You can't day trade doing that. Like, it's all good saying, oh, I can be on build, I can go to the office, I can sit on the building site, I can look at my phone. It's all good saying that, but realistically it doesn't work. You need to be able to set your trades, set your orders, be done. Let it play out, and then you ain't sitting on your phone, on site, in the office, whatever you're doing, at your job, looking at your phone, panicking because you're in a day trade and it's lasting 5 minutes and you're all panicking because you want to be in and out, you're seeing candles fly about, whatever. It's manic. Just get a nice strong list, go through them every weekend, see what looks good for the Monday ahead. Look, this trade here, I actually marked this out, I think, when we was doing the course last few videos. That would have been a loss, but then it did go our way. But then, look, we could have continued again. So, the reason, liquidity sweep here, push upside, we break all of this structure here. So, you don't even mark your breaker structure. We pull back down, tag in, and reverse. So, Bosch to the Bosch, enter off of there, and then it hits the highs. Liquidity sweep there where that blue line is. Push up, breaks multiple structure levels, come back down, tags us in, and reverses to the upside. Could have took that loss there and then got straight back in, change your bias, go. Done. This one here, we get that liquidity sweep, push to the downside, break structure, return to Fibonacci, enter, done. No more gaps there. Let's go back. This is AUD. Yeah, we're on AUD USD. Same thing, liquidity sweep, push down, break structure, pull back, enter, done. Quick. Continuation model, push down, break structure, pull back, enter, push down, done. Very simple. We're just looking for that zigzaggy style in the market. Here, liquidity sweep, push up, break structure, slow pull back down, enters, pushes up, completed. Liquidity sweep, push to hand. Market structure shift, return to Fibonacci, enter, push down, completed. Happens over and over again, guys. You can literally just come on it and just find the trades over and over and over and over and over again. Let's just go to a random pair. AUD, NZD, what's happening here, guys? What's happening here? Let's see if we can just find something off the cuff. So we're in an uptrend here, so you can see here liquidity sweep, push up, return. This would be off a lower time frame. Let me see if I can find it now. Probably not going to find it now. I should have done it off the fucking. Let's go back to the higher time frame. Was it on the 1 hour? I can't even remember what was on there. This area. I think it was here. Let's go to the 15. Oh, let's go to the 15 minute. This is going to be the last few I'll go over. Okay. Yeah, there we go. So this high here creates this low. We push up. We don't break. Let's just get rid of that. So we don't break. So we're still in the downtrend. We just wick through. Then we push down. We wick, sweep out liquidity. This is off the 15 minute, but a higher time frame was the 1 hour. Liquidity sweep. We push up. We break structure. Because what was the high? Oh wait, sorry. This is still our structure high. So this is our structure high. Here we actually finally break structure or market structure shift. What was the low that created that high? Here to here. And this obviously would have happened overnight if you're in the UK, but then you would have got tagged in, stops at the lows, take profit at a high, and you would have woke up to a take profit. Literally, so this, if you're UK, you would have got hit take profit at 6 o'clock in the morning. Perfect. You would have woke up and your trading day would have possibly been done already. And that's it. Literally, that is it, guys. So that's the model we're looking for. Don't know how long this video has been going on for, but we've literally, even the next video that I had planned, which was the final video, or the next two videos, sorry, I've literally gone over it all in this one video. So I'm going to have to think about even if I do another one. But that is the entry model.
Because the next video I was going to go over just some trades, and we have literally done it. So yeah, that is it. This is it. This is what will get you out of your 9 to 5, lads. EuroCAD. Let's see if we can find anything here. Some charts are just shit. Let's be honest. Fucking hell, some of them just move like absolute shit. Sweep, push down. There we go. That's another one you can just plot out. Even though we're in a very when we're talking about market structures and stuff like that, consolidating market. So this one's a bit of an iffy trade, but the pattern is still there. You get the liquidity sweep, then you get the market structure shift or the breaker structure. Fuck knows what you want to call that. We are in sideways market, so just call it a breaker structure because it's a ranging market. And then we push up into our entry zone, take out liquidity, go into the take out liquidity, go into the fair value gap, which is here. I'll highlight it because the indicator's not highlighting it. So we go into the fair value gap, which aligns perfectly, well not perfectly, but aligns really well with our Fibonacci. Take out all this internal liquidity here, all these highs. Spike up, take out that liquidity, fill that fair value gap, tap us into our entry, and then it reverses to the downside. Another perfect setup. And then what happens? We literally push down, we break this low, high, new low. What we're looking for, continuation model, because now we've finally broke out that range. And there you go, another entry there. Stops at the highs, take profits at the lows. Another 2R. Another 2R, which would have happened through that gap, but you would have hit take profit. And then here, no entry there, but it's another continuation. That one breaks there, so yeah, but nothing there anyway, so it doesn't matter. Then nothing, and it's just been dumping because of the war in Iran. But yeah, guys, that is literally it. So if I go back to the NZD CAD, but you can see how we're just flying through these charts and the entry model will just appear over and over and over again. You can go back through time, we can go back forever, and you will see it just happen over and over and over again. You might even see some what I don't see at the minute, like you get a liquidity sweep here, push down, liquidity sweep, push up, break structure, pull back down, return, Fibonacci. As soon as we get this black candle, we plot out our Fibonacci, enter, bosh, stops at the lows, take profit at the highs, and it plays out perfectly. There you go. Happens over 3 days. So that's a 3-day trade, but it still plays out. You can move on to another pair, let that one play out, you're good to go. Yeah, so like I said, you can just keep going back and back and back and back and back. Nothing, that's the liquidity sweep happens there, no break of structure. Another entry model there. I've obviously got that plotted out. That was obviously a lower time frame, but if I go lower, it's going to go back to the start. Liquidity sweep, push down, break structure, return, bosh. Another continuation model here. So we're just looking at this, for example, continuation model. You can see entered, push down. Then you could have done another entry model here. Would have been very close to stop loss, but you would have got tagged in. Continuation would have pushed you down, you would have got tagged in. Then this one here wouldn't have happened because you would have had this high here to here. Obviously it didn't even come up, then doesn't matter because once we break structure here, you can just replot. And then what do you notice about this one? It took out this liquidity area. So it's come back, spiked up, took out that liquidity, pushed down, broke structure, returns. Oh, it's a shame. It doesn't actually hit take profit. I mean, it doesn't actually hit their entry. But you get the gist. Then we move away. Let's see if we can find anything. Liquidity sweep, push up. But I wouldn't have come back to an entry. There we go, another one. So you get liquidity sweep, push up, bit of a messy push up, but it does end up happening, and then you come here, boss the low, they created that high, comes that perfect, tags, respects, pushes away, hits take profit. Here's some mini continuations, nothing very clear or great for the
strategy though. But listen, you're getting the point. So like I said before, what are we looking for? We're either looking for a sweep and then a return. So that model, or we are looking for that to happen, obviously. So the sweep, and then once we hit that, we break structure here, we're looking for that continuation model, which would be here. So this would be one entry, that would be the other. So we're looking for those two style of entry models, and that would look like that on that one. Let's just pull that up to make it look neat. And then that on that one. Let's pull that one up to make that look neat. Liquidity sweep, structure shift, enter, bosh. Liquidity sweep, structure shift. We already got that one. We're looking for that continuation. We break structure, return, push, done. And then that's it. Guys, I actually think that is literally going to be it. I think that's going to be it, because the next video was literally the final video, the full strategy and different trade examples, and we've literally gone over entry model step by step, pairing it with the time frames, i.e. using our ranges in the daily and weekly time frames to align with our structure and our entry model. Obviously I was going over that with it was actually this pair, wasn't it, the NZD USD daily range here. So the daily range, we want to see that alignment on the lower time frames, but we can get in off of that continuation model on the daily, so you can get a higher time frame daily entry model. So yeah, so we are looking, like I said, we can use a daily range, we can get an entry off the daily range, and then we want the lower time frames to align with our higher time frame to get the entry model, which we've gone over so many times now. Liquidity sweep, market structure shift. We want a fair value gap or a demand zone, preferably to line up with our entry Fibonacci level. Set our orders, let it play out. And like I said, in this specific trade here, you would have got two trades if you wanted to trade off the really high time frame, i.e. the daily, and then you would have got the lower time frame entry model as well. Yeah, so we've done literally every video that I wanted to do. Entry model step by step, pairing the time frames, i.e. the ranges with the daily, 4 hour, 1 hour. Yeah, and then the entry off the 4 hour, 1 hour. We've aligned that perfectly here. And then the last video was literally the full strategy, which we have literally just done, putting everything together, going over trades, and that was it. So different trade examples, finish, course, and we've done it all. Guys, we've done the whole course in what, 5 videos, 6 videos, I don't know, but like I said, the CM Capital Pro version 2 indicator is very important to this strategy, just because it helps you highlight your fair value gaps and things like that, and your highs and lows and stuff, and your breaks and structures. That helps you perfectly. You even plots out your market structure shifts. So make sure you've got that on. And obviously, if you're struggling with your market structure shifts and break structures, you can come into this, you can turn it all on. Obviously, I've just got it set to how I set with my day trade and stuff. So don't copy these ones here exactly. Make sure you've got it set up to how you're happy with using it. Our entry model is very clean. We're looking for a very clean liquidity sweep, stuff like that. So we want that liquidity sweep to happen, which happens here. So we want that very clean liquidity sweep to happen, market structure shift, and that happens here on the lower time frame. This is that setup happens here in this lower time frame. So you can even go on to NZD USD, go back in time. The date on that trade is October the 29th, 2005. So just go back and look at that area. That is the perfectly clean area on NZD USD. So go back in time, look at that, go over that model, go over that, screenshot the daily, go down to the 1 hour and screenshot that as well. Save it, use that, look for that over and over and over and over and over again. We're looking for that liquidity sweep, market structure shift, return to Fibonacci. We preferably want to see fair value gaps and supply zones or demand zones if we're looking for buyers in those areas. Get the entry, get your short position in play, and make some fucking money. yeah, and that is literally it, guys. If you're looking for a prop firm to trade with, down the bottom here you'll see the E8 Markets. I am affiliated with E8 Markets. If you use my code CMCAP, whatever discount is on, you will get the maximum discount with that code. So use that code, because it doesn't matter what account you buy, whatever maximum available discount is available on that website, whether it's a hidden discount and it's not promoted or whatever, you'll get the maximum discount using that code. They haven't long gave it to me, so use it. It's good to have. I've been using it myself as well, so it's really good. Use that code. If you do want to join my academy and learn the day trading side of things, links are in bio, or go to cmcapital.co.uk and you can join through the website. I do have a free section in the Discord, but it's very minimal. So don't think if you go into the free section you're going to get you're going to learn everything, because you're not. It's literally just in the free section you get some of my stuff, so you can see some of my trades and stuff, but they're not trade setups, they're just trade wins. And then you're going to get a free chat with other free members, a profit losses for you guys, so you can upload some chats or whatever. Upload some charts, and that's about it. There's not much in there, but it's just a little entry zone to the Discord. And then you've got the Discord only access, which is £15 a month. And then you've got the Academy, which gives you the full Discord access, the full course, all future updates, everything, for £500 all in. That's all it is. So you pay £500, you get Discord for lifetime. There's no monthly fees, nothing. You get Discord, everything, all the course, whatever, everything. That's it. Flat fee, none of this monthly fee. The only monthly fee is if you just want to join a Discord and get the extra Discord stuff. But you won't get the course, obviously, with the Discord entry stuff. And that is it, guys. I think I've gone over everything. But either way, thank you guys for watching, and I will see you guys in the next videos.